if you look at wages over the last 50 years, 40 years, wages have basically, in inflation-adjusted terms, been flat-ish. They've gone up a bit. Now, inflation itself has not gone up a lot, CPI inflation, because of technology, globalization, etc., and wages. But then there's a bunch of assets that have gone to the moon. So if you look at a 30-year-old in 1979, 1980, which was the baby boomer, they had really cheap property prices, all-time record low valuations of equities, and all-time record low high interest rates and high credit spreads. It was a gift of an opportunity. The 32-year-old now, millennial, is seeing all-time record valuations in equities, all-time record valuations in bonds, the lowest ever interest rate in credit, and the highest ever property prices. So, I mean, that's a problem. And that's to do with this wage deflation issue, because you've now got the baby boomers and the millennials in the workforce at the same time technology is destroying jobs, same time that the Chinese and the Indians and the Turks and the Vietnamese and everybody else are taking jobs away. It's all happening. So I don't think you can generate inflation. So this reflation, what is it? It's driven by a bunch of commodities that have supply restrictions. So they've gone up, the stimulus, so that tends to goose economic growth for a bit. But I think it just fades, as it always does. I think there's a lot of people across Europe, the UK, the US, who are basically in a holding pattern where they've been forgiven payment of their debts for the time being, temporary payment of their debts. And those debts are going to come due. So either the governments write them off and the central banks print more money, or those people are going to have to forego expenditure at some point, which is one of the reasons the saving rates went up so much with all the government handouts. So I think there's a lot of consumption brought forward. I know, because I renovated my house both in Little Cayman and Grand Cayman while I was in lockdown. Well, we weren't really in lockdown here, but the islands were closed. And I've foregone all my future consumption. You know, I spent all my money, whether everything I could put into Bitcoin and Ethereum, and all the work I did in my house. And that's it. You know, I'm not going to do the same next year, but everyone's kind of done the same, right? Everyone's kind of redone something. So I think there's a lot of consumption brought forward. So I think growth the second half of the year is going to be weaker. I think bond yields don't go much further. But anyway, what's amazing is the central bank are not going to allow them to go much further either. So the ECB, the BOJ, and the Reserve Bank of Australia have all been stopping yields rising. And I think if the yields rose any further, the Fed would stop them too. What's interesting is the seasonal cycle of Bitcoin is pretty clear. So it goes up early Jan, then corrects, then goes up in Feb, corrects in March, April. We're kind of seeing that exactly play out now. And then it explodes into June. I think it gets to 100,000. And then it corrects sideways. You know, sideways in Bitcoin terms is like down 30%, but for an extended period of time until, let's say, September, October, maybe a little bit earlier, and then explodes into the end of the year. What's interesting is this cycle also looks pretty much like the 2013 cycle, pretty close. It's actually pretty close. It's diverging a bit from the 2017 cycle because it's actually ahead of it in terms of price movement. So that's how I see the rest of this year playing out. Next year, I'm kind of with you. I'm kind of thinking that we won't have a big collapse because of the new participants. Mm-hmm. So what happened last time around, it was all retail, and retail had made a lot of money. And so they wanted to convert back to fiat to buy things. And the more it went down, the more they thought, oh shit, I want to buy that car I was going to buy, and stuff like that. But with more institutional adoption, I think the volatility comes down over time. And maybe it just sideways corrects like gold did for the last few years, where it traded down 30%, but over 18 months. So it's just boring. And you bore people out of the trade, and some people accumulate over that period. I think that's probably the most likely. I think there's also a outside chance that, you know, we all look at Plan B stock to flow, and I use a number of different ways of getting a price projection. I use a regression analysis on the log chart. That gives me, you know, for it to get to kind of one standard deviation overbought, it's about 400,000. But if it gets to two standard deviations, where it got to the last two times, it's 1 million. I think there is a risk that we all think, and I see Plan B asking this question a lot on Twitter, where do you think it tops out? The skew is to the low side. the skew is around the 150,000 to 200,000.
200,000, I agree, yeah.
This 288,000 number, people are really not sure on.
Yeah.
And anything higher, they're like, no chance, the lowest probability of all. And I'm like, I kind of like those odds. I kind of feel that we could have that shocking moment where a lot of people sell out at between 150 and 250 for these reasons. We've all got kind of seen that, and we all think that could be the case, and we could overshoot. We could see an elongated cycle for the reasons that you said, because the institutions continue. So I don't know. It's hard to play. I think I will probably take some off the table somewhere in that, and probably hold some. So something like that. It's difficult to know what to do. You can just hold it. It depends what age and what you want to do with the money. You either want to keep it in Bitcoin because you want to just participate in the next cycle, so you just think of it as just a savings vehicle, or you want to cash in for lifestyle chips and buy yourself a house or a car or do whatever you want to do, and you need to time that if you want to take some money off the table to use for other purposes. I think the antithesis that I've got that is not on people's radar screens is, I've discussed this a couple of times and a lot of people still don't understand it, is Bitcoin's real value proposition is this store of value with limited supply that's kind of understandable. So we've heard the BIS and the IMF talk about the need for digital currencies. They've also talked about a new Bretton Woods moment. And what they've been talking about with that is the ability basically for everybody to print money at the same time in a unified agreement. Why? Because then you don't get one currency out of whack with the other. So you create less economic disturbance. Now, it's obviously that would be very powerful for Bitcoin and gold and some assets, probably equities. But what happens after that? What happens if they said, okay, we're going to create a global basket of currencies. And to be a member of this new world currency, your money supply can only increase by 2% a year or less. And it's rules defined. That makes that currency pretty interesting, right? Because it has some of the attributes of what cryptocurrencies introduced. It could be tokenized too. And anybody who fails to meet the criteria gets ejected from the basket. So then you have less of a need to protect yourself against the largesse of governments because you have a globalized currency. That would change the equation. It wouldn't change the other side of the equation, which is the new digital world that I'm talking about. So that will explode in that environment. But Bitcoin would still be perceived to be a harder asset, but it'd be kind of like gold versus the US dollar.